Good to be back. I've been away. I was away for a week, but then an illness. My wife got a kidney infection, which was all hands to the pump. Unfortunately, she wasn't particularly well. Anyway, hopefully we're over that. But here we are. A lot has happened actually in the 3 weeks that I've not presented, although I follow the markets as closely as everyone else. We've had an interest rate cut, a jumbo cut in the United States, which I was a bit surprised by it, but yeah, there we go. But they're already speculating about another half-point cut at the next meeting. I don't know. I think that's just too much, but it's sort of 50-50 at the moment. Morning to you, Gary. Yeah, good. Okay, well, let's just have a look what's happening. What was really interesting last week actually was not in the Western markets, but actually what happened in China. It was an absolutely astonishing rally. Probably the best one I can show you is, okay, well, whilst waiting for it to refresh, I can tell you that the Chinese equities, the CSI 30, 300, so that's the top 300 shares in China, was up 15.7% on the week. Just extraordinary. You might think, well, how on earth could it rally that much? It's something that's, they've overtly attempted to support the Chinese economy. When I say they, this is the Beijing and the People's Bank of China. And it followed this announcement about a very substantial economic package, which also included what the People's Bank of China has called a big lending pool of 114 billion. I mean, it's huge. It effectively is designed to support the stock market. But you'll probably know this week is something called Golden Week. It's a celebration of National Day in China and in Hong Kong. And the markets are shut from Tuesday all the way through to the end of the week. I actually think the moves that we've seen are likely exaggerated last week in China because of the market being shut this week. At least that's what I think is going on. Anyway, when I have cured it, I'll be able to show you a chart or two. Anyway, European markets, yeah, just a quick question about that. DAX was particularly strong. The DAX was up 670 odd points. That's 3.58 points, which was largely down to the fact that a lot of what's been holding back Central Europe and the Eurozone, and in particular the German economy, has been the really poor performance of the Chinese economy and the fact that it hasn't really responded post-pandemic. Anyway, not so last week. Certainly a lot of expectation built into that move, but it was up 3.5% on the week. And that's the DAX's best weekly performance since May, which is, yeah, Peter, I'm not sure. I've actually just messaged our customer support to find out what's going on, but something's perhaps not right. I'll let you know as soon as I do know. US markets, yeah, continue to push ahead. S&P was up 0.6%. The Dow was up 0.6%. Totally different indices, of course. One's a market cap weighted, one's price weighted. And I think we're really just responding, or the US is responding to the jumbo interest rate cut that previous week. So it didn't happen last week, it was the previous week. Just to remind you all, the US interest rates were cut by 0.5%. The target rate now is, as you can see on the screen, 4.75 to 5%. And now the speculation is sort of 50-50 that they're going to cut by another 0.5% at the next meeting on the 7th of November. I somehow doubt that, but at the moment it's a 50-50 probability, which that's just what the markets are telling us. I think it would be a 0.5-point cut would be a stretch, really, because I think, the Federal Reserve, the FOMC probably would want to gauge the effect of this first significant cut. And remember, it's the first cut in interest rates that the US has had since the start of the pandemic in, March 2020. Yeah, but we still also had some pretty positive news that sort of supported it. We had the PCE data last Friday. Do you remember? This is the data, the inflation gauge that the Federal Reserve follow. Which came out on Friday. Was it the previous? Yeah, here we go. Yeah. Core PCE data. That stands for the personal consumption expenditure, and it's the data that the Federal Reserve prefer to follow. It's something that it's well publicized, and that actually came in better than expected. The headline rate came in at 2.2%. Actually, it's not showing here on the screen, but I can tell you the headline rate came in at 2.2%, and that was below expectation of 2.3% and much better than a 2.5% print in August, which was obviously for July's reading. The core PCE, however, didn't match that fall, which was expected. That the headline rate was, the core rate was expected at 2.7. It came in as expected, so it didn't beat that consensus as the headline rate did. Anyway, it's still positive news. UK markets, gosh, what can I say about it? It's just weird. I know we've got, is it updated? Is it? No, I'm going to log out and log in again. If I can't do it, I can't do it. I don't know what's going on. I'm sure I have to reboot. I was told to reboot because it was a Windows update, and I'm sure that's completely knackered my computer, which really annoys me. Anyway, all I can tell you is that the UK market was up. Yeah, it did a decent job, 96 points, so just under 100 points, 1.17% higher last week. I find it really interesting. You know, I read a lot, and I was reading a very interesting article in the FT, how that the Labour Party conference in Liverpool was a bit of a disaster. And it's almost like Keir Starmer's new government seems intent on snatching defeat from the jaws of victory. They've got a whacking great majority, but this conference in Liverpool was, from what I understand, particularly underwhelming, with many wondering what the point of it was if there were no major new policies that could be presented and discussed. And I think a lot of captains of industry that were invited there said it was a complete waste of time, and the 2,000 or 5,000 quid they paid to attend, because they couldn't speak to any ministers because ministers had nothing to say. It just seems a bit. I think the point from the FT is that the Labour Party had spent a long time in opposition. Surely they had time to prepare for this. Well, yeah, it wasn't the way it should have been. I think the only news that I could see was that Chancellor Reeves was considering a revision to the non-dom tax overhaul, which was designed to bring in more money. And I think it seems that Reeves and perhaps some of our advisors were the only people that didn't realise that wealthy non-doms would just up sticks and leave, which obviously would have resulted in a potential fall in the tax take. Yeah, that's reason why it was all like that in the first place. US dollar, just a quick look at that. You can see that the dollar continues to fall last week, and that's really down to the fact that traders are pricing in that possibility of another 0.5% rate cut at the next FOMC meeting. Yes, I know we may not think it'll happen, but you know, it's a journey we go on with trading. You know, when the data comes out, that is just part of the process. Sterling, yeah, sterling is particularly strong. Look at it against the euro sterling. Yeah, it's way. I mean, last week at one stage, I think we were the strongest versus the euro since April 22. I was looking at. Yeah, you got to go a long way back. April 22. Yeah, looks a bit unintelligible, but I can tell you this is basically where we were last time on the screen. Yeah. So yeah, sterling particularly strong. Andrew Bailey, the governor of the Bank of England, said that interest rates would probably be cut gradually, but the Bank of England and this was his quote, needed to be careful not to cut too fast or by too much. And that shows a certain amount of hesitancy. And I think, that probably sums it up. Whether we get a rate cut in the November meeting or one in December, we will see, obviously. Economists, and analysts, they all seem to be getting quite bullish of what's going on in the UK. Isn't it funny how things change over the months? This year, at the start of the year, there were forecasts for lots of rate cuts, and now the economy is performing in one of the best performing G7 economies, and it's very difficult. I think politicians get frustrated by it. Investors get frustrated by it as well, and I think UK markets are probably really undervalued, I suspect. But anyway, on the sort of forecasting front, it's just interesting that last week Barclays Bank, Bank of America, and Goldman Sachs, in fact, Barclays and Bank of America were forecasting 135 sterling versus the dollar. Goldman Sachs is talking about a target of 140 over the next 12 months. I mean, bearing in mind where sterling is at the moment at 133, it's come from what, 123? It's already done a lot. I wouldn't be surprised if it stalls a little bit around here, to be honest. Michael, surprisingly, Thai baht higher against most currencies. Yeah, it's one of the best performing developing currencies, isn't it? The Thai baht. Yeah, I did notice that. Yeah, interesting that you followed that, Michael. Interesting. Gold. Gold just remains really strong on the back of a weaker dollar. You'd expect gold to continue to perform. It pulled back a little bit last week. We were down, $30, something like that. No, we can't have been. We went down $30. We closed there. No, 26.20. Yeah, we were, up 30. Yeah, I just got the number wrong, the minus rather than the plus. It was up about $32. It's obviously close to its all-time high, and it's the weak dollar that's really propelling it. Plus the fear of an escalating war in the Middle East, which you'd expect to underpin prices. I don't know about you, but everyone says they're worried about the war escalating in the Middle East, but it's in Lebanon, it's in Yemen. How much more escalating does it become? I suppose if Israel attacks Iran, I don't know. Oil. Yeah, bit of a tumble midweek last week. News that Saudi Arabia, and this was a discussion. I'm not sure that I know the Saudi Arabian oil ministry hasn't mentioned anything. But the news is that Saudi Arabia is about to abandon its long-term target of $100 per barrel oil. And you think, well, have we been anywhere near 100? I mean, the highest we got was, around $91 in mid-April. But really, we've been nowhere near it for months and months. And I think all that's happened with OPEC's production cuts that has also partly been sort of funded by Saudi Arabia is that it's played into the hands of the US, who have increased their production and have gained market share. I think it's rebounding here because of what's going on in the Middle East, I'm sure, as Israel is broadening its attacks, as I said, to those militia groups in Yemen now as well as Lebanon. I find it really interesting and lovely in the pumps. I think I filled up at 128.99. Remember, the price of crude and the price of petrol and diesel here in the UK is a function of the oil price and of sterling. And with sterling as strong as it is against the dollar, that means the price of oil in sterling is significantly weaker. Influence of hybrid vehicles. I'm glad you said hybrid, Michael. I think EVs sales are falling quite sharply, and it's all down to the minerals and the rare earths that are needed to produce a lot of these batteries. And I think people have realized we just don't have the infrastructure in place to handle a massive boom in EV sales. And I think the hybrid model, look at Toyota, aren't they looking clever? Very clever. They've carried on with it. But yeah, I think longer term, Michael, I think crude, gosh, crude oil could easily head below sort of 50, $40. Why not? Yeah, hydrogen. I wish it could compete. I still think that is a strong possibility as a mobile fuel rather than electricity. Just depends how much, the Chinese have really cornered the market on all those commodities that are needed. They've got a bit of a stranglehold on it. Okay, data. Let's go to here. Golden Week in China. I always used to visit my daughter who lived in Hong Kong for many years. And I always used to go in early October. My daughter always said, it's the worst time. Why are you coming then? I don't know. It was like after the summer or whatever. But anyway, it's called Golden Week. It's a celebration of National Day in China. They only celebrate it for 2 days in Hong Kong, but in China, the markets are shut from Tuesday through to Friday. So it's a long old holiday. And that's partly one of the reasons why I think there was this big frenetic move in Chinese markets last week. Anyway, we've got some other key data. We've got Eurozone inflation and non-farm employment change. So let's have a little look at what's going on. It'd be nice to get to the right week. We've already had out manufacturing and services PMI data out of China. China's economy is sort of close to the 50 level, which implies no growth in either sector, as you can see here. That's not good enough, though. China needs growth to remain productive, to remain a vibrant economy. And even the 5% GDP target looks like it's not going to be achieved. And that massive stimulus package from last week, it just depends how long that's going to filter through. I think it looks like a lot of it's been used to support the stock market, but they've got to help the property sector and the house building sector as well. Anyway, I'm sure Beijing will be hoping that the stimulus package will help improve the economy. But for now, the Chinese economy is not really growing much, nothing like enough. We've got Jay Powell, the chair of the Federal Reserve, the US Central Bank. He's speaking at somewhere in Nashville, I think, at the National Association for Business Economics annual meeting. Only reason why I mention it is because it's unusual, but they have a Q&A session, so they're taking audience questions at the end of it, which I find really interesting, because during a speech which is written, it's normally very measured. It's when there are ad hoc questions and answers that you get to hear some real interesting stuff, and that's why I quite like those sort of speeches. Anyway, that's this afternoon, Tuesday. Well, I've already mentioned it. The bank holiday starts for the rest of the week in China. Golden Week, as I said, it extends through to the rest of the week, and the Chinese markets will be shut until the following Monday. We've then got headline and core CPI data out of the Eurozone. That's inflation data, obviously. Both expected to fall 1.9% and 2% respectively. That's for the headline and for the core rate. The core rate is used to sort of focus on the underlying rate of inflation. So we use a core rate here. They use one in the States as well, and it removes the volatile components that cause a lot of sharp moves up and down. And that's the food and energy component. So they strip that out, and we focus on the core rate. But the headline rate is also important, because the headline rate is what central banks target. So this 2% that the Bank of England target, that 2% that the Federal Reserve, 2% that the European Central Bank targets, that is really important as well. So we look at both of them. Yeah. I think that's going to help the ECB ahead of their next meeting. I think a consensus number, i.e. as expected, will probably lead to a rate cut that I think up until last week was not really likely. So I think the euro and Eurozone assets will be quite sensitive to that. really. It's interesting because we had some particularly bad, disappointing, I should say, Eurozone manufacturing and services PMI data out last Monday, which up until then, I think analysts, economists did not expect the bank to be cutting rates this October. So the next ECB meeting from the Governing Council is on October the 17th. But it looks like that with that disappointing data, and that's why this inflation data out on Tuesday is more important. And it may well confirm in traders' minds that the European Central Bank will be cutting rates in October. We're not there yet. It's the last day of September today, so I can't say this month, next month. Yeah. US, we got ISM manufacturing data. Yeah, all I can say is it's still marred below 50. You can see here expected at 47.6, last at 47.2. An improvement, but really way below 50, which basically is not good news for the manufacturing sector, which has always struggled ever since the cost of living crisis, inflation spike, because energy costs were always bound to hit manufacturing more than the service sector. Dollar will be sensitive to that announcement there, that's for sure. We then have got OPEC. Yeah, quite interesting in light of what's going on with the rumored announcement from Saudi Arabia about abandoning this $100 per barrel target price. Anyway, they're meeting at a time when the price obviously is languishing. There is a potential for the Chinese economy to improve, but it's going to be a long haul, and that's probably not reflected in the price at all yet. But it's not certain either, is it? I think I think there's going to be some interesting conversations, but it's it's an admission by Saudi Arabia that OPEC's policies had not really worked, that the cut in production, all it had done was to help OPEC's competitors, i.e. the likes of the US, who were increasing their production, just take market share, which is something that Saudi Arabia will be keen to get back. We then have ADP non-farm employment change. You probably hear me spout about this every month. It's monthly data, always it precedes the official data from the Bureau of Labor Statistics that comes out this Friday. It's a private payroll company. The data tends to be a bit erratic, but if it is something that's way off base, we're expecting 124,000 new jobs in September. It's better than August, but it still shows a gradual decline in job creation, which is as expected because the US economy is cooling. Yeah. Thursday, we have ISM services. That's something that's more important than manufacturing, and it's certainly performing better, that sector. We have two sectors in an economy, manufacturing and services. In the developed world, services are a lot bigger portion of our economic output than manufacturing, especially here in the UK. We're about just over 80%. Anyway, in the US, the ISM service is expected at 51.6, unchanged from last month pretty much, but still above that critical 50 level. The dollar will be sensitive to that as well. And then the main event of the week, non-farm employment change. Important because the Federal Reserve follow this data as well. It will affect what they do with interest rates as well. That's one of the reasons why interest rates have been cut as the employment market cools. We're expecting a change of 144,000 new jobs, with average earnings falling slightly from 0.4 to 0.3%, whilst the unemployment rate staying at 4.2%. This is consistent with the narrative of a cooling US economy, which is the reason why the Federal Reserve are cutting rates. Will they look at this data and think, yes, I've got to cut by 0.5% in early November? I just don't think so. I don't think so, unless it's way off base. Anyway, the dollar is very sensitive to this release. US assets are and global assets. It affects all markets. It'll affect our market as well. So 1:30 Friday afternoon, that's a key one to follow. That's it. We're 9:09. If I hadn't been messing around trying to get my charting center working, I'd have probably finished even earlier. That's it. You've been very quiet. You've been taking it all in, or I don't know, watching the news or doing something else. Any more questions, anyone? Have you enjoyed it? Has it been informative? Gary, that's very kind. Good. Well, listen, if you've got no further questions, I'm happy to finish. Yeah, all good. Michael, Peter, David, thank you. Yeah, no problem. Yeah, Peter, I've been told it is working, so maybe it's down to a Windows update. I haven't updated my computer at home since coming back. That's probably my fault. All the best, and have a good one, and we'll catch up again next Monday at 8 o'clock. All the best. Bye for now.